Have you ever thought about what banks really do with your money? It's not just sitting in a safe. While your money rests in your account, banks are quietly using it to make billions. Shocking, isn't it? Imagine working tirelessly to save your money, trusting your bank to keep it safe, only to find out it's being used to generate billions in profit while you earn almost nothing. Banks have become a vital part of our lives, but behind the scenes, they operate in ways that directly impact your finances. In this video, we'll break down how banks profit from your money and show you how to take control of your financial future. Section 1. The basics of banking. Let's start with the foundation. How do banks actually work? Think of a bank as a middleman. When you deposit money into a savings or checking account, the bank pays you a small amount of interest, usually less than 1%. But here's the catch. Banks don't just let your money sit there. They lend it out to other people or businesses at much higher interest rates. For example, if you deposit $1,000, the bank might pay you $5 in annual interest, 0.5%. But they lend that $1,000 at 5% interest, earning $50. After paying you, they pocket the remaining $45 as profit. This is called the interest spread and is one of the main ways banks make money. Banks are essentially middlemen. They take money from you at a low cost and lend it out at a high cost. And because most people trust traditional banks as the safest option, banks don't feel pressure to offer better rates. Loans are where banks make the majority of their money, whether it's for a home, a car, or a business. But they don't stop there. Banks lend out far more money than they actually have on hand. This leads us to the concept of fractional reserve banking, which we'll explore in the next section. Section 2. Fractional reserve banking, the hidden engine. Now that we know how banks work, let's dive into one of their most powerful and hidden tools, fractional reserve banking. It's the system that allows banks to lend out far more money than they actually have. Here's how it works. Imagine you deposit $1,000 into your bank account. Most of us assume the bank keeps that money in a vault, ready for us to withdraw. But that's not how it works. Instead, the bank keeps only a small portion of your deposit, say $100, as reserves. The rest, $900, is lent out to someone else, like a business owner or home buyer. But it doesn't stop there. That $900 loan is deposited into another bank, which keeps $90 and lends out the remaining $810. This cycle repeats, creating new money at every step. In the end, your $1,000 deposit has multiplied into several $1,000s circulating in the economy, money that didn't exist before. Why do banks do this? The idea is to fuel economic growth. By lending out more money, banks make it easier for people to start businesses, creating jobs, buy homes, boosting the housing market, spend on goods and services, driving the economy forward. It's like oil for the economic engine, keeping everything running smoothly. But this system isn't without risks. First, there's the issue of liquidity. Banks only keep a small fraction of deposits in reserve, so they don't have enough cash on hand if too many people want to withdraw their money at once. This is called a bank run, and it can lead to bank failures. Second, it can create economic instability. By lending out more money than they have, banks can contribute to bubbles in the economy. For example, excessive lending in the housing market led to the 2008 financial crisis. When borrowers couldn't repay their loans, the system started to collapse, leaving millions of people financially devastated. Finally, the entire system relies on trust. If people lose confidence in banks, the system could crumble, as no bank can repay all its customers at once. Fractional reserve banking is a powerful tool that allows banks to multiply money and grow the economy, but it also places your money at greater risk than you might realize. In the next section, we'll uncover another hidden aspect of banking, where your money really goes and how banks use it to generate even more wealth. Stay tuned. Section 3. Where your money really goes. When you deposit your money into a bank, you might assume it's just sitting there safely, waiting for you to withdraw. But in reality, banks don't just lend your money to other people. They also invest it to maximize their profits. Banks take your deposits and invest them in assets like stocks, corporate bonds, and government-backed securities. These investments often earn them significantly higher returns than they pay you in interest. For example, a bank might use part of your deposit to buy government bonds, which pay steady interest, or corporate bonds, which offer even higher returns. Some banks also take risks in the stock market, speculating to multiply their profits. Let's look at a real-world example. Imagine you deposit $10,000 in your savings account. The bank might lend out $8,000 as a loan, but the remaining $2,000 could be invested in the stock market or used to buy government bonds. If these investments perform well, the bank makes a hefty profit. But if the investments fail, your money was still part of the risk, even though you didn't consent to it. One of the biggest concerns about this system is the lack of transparency. Banks aren't required to tell you exactly where they're investing your money or how much risk they're taking. This means your hard-earned savings could be tied up in risky ventures without your knowledge. And here's the kicker. While banks earn significant returns from these investments, they give you only a tiny fraction, sometimes less than 1% in interest. Meanwhile, they could be earning 5%, 10%, or even more from your money. So while you think your money is just sitting safely, it's actually out in the world, working hard, not for you, but for the bank. In the next section, we'll uncover yet another hidden profit stream for banks, the fees and charges they take from you without you even noticing. Stay tuned to find out how much these fees really cost you. Section 4. Hidden fees and charges. The silent profit makers. Let's talk about one of the sneakiest ways banks profit from your money, fees and charges. Most people focus on interest rates, but banks are quietly earning billions from fees that are often buried in the fine print. Every time you use your account, there's a chance you're being charged. For example, if you accidentally spend more than what's in your account, you could be hit with an overdraft fee. These fees can be as high as $35 for a single transaction. Here's a shocking fact. In 2022 alone, major U.S. banks made over $15 billion in overdraft fees. And guess who these fees hurt the most? People who are already struggling financially, those living paycheck to paycheck. But overdrafts aren't the only way banks profit. You might also be paying monthly maintenance fees just for keeping your account open, ATM fees for using a machine outside your bank's network, foreign transaction fees when you travel or shop internationally. Individually, these charges might seem small, but they add up fast. For example, a $10 monthly fee costs you $120 a year. Combine that with overdraft fees and ATM charges, and you could easily lose hundreds of dollars annually without even realizing it. Why these fees go unnoticed? Banks know that most people don't read the fine print of their account agreements. This lack of transparency makes it easy for them to charge you without you noticing. They also design their systems to maximize fees, for instance, processing larger transactions first so your account overdrafts sooner. The good news is you can take steps to avoid these hidden charges. Check your statements regularly. Look for fees and charges you don't recognize. Switch to a low-fee bank. Many online banks and credit unions offer fee-free accounts. Set up alerts. Most banks let you set up notifications when your balance is low to avoid overdrafts. Banks thrive on fees because they know most customers won't question them. By staying proactive, you can keep more of your money in your pocket instead of handing it over to the bank. In the next section, we'll explore another massive profit engine for banks, loans and credit cards, and how they use high interest rates to their advantage. Don't miss it. Section 5. Loan interest and credit cards, the real moneymakers. Loans and credit cards are some of the biggest profit generators for banks. They offer convenience to customers, but they're designed in ways that heavily benefit the banks. Let's break down how they do it. When you take out a loan, whether it's for a car, a home, or personal expenses, you're agreeing to pay back the borrowed amount plus interest. This interest is where banks make their money. For example, imagine you take out a $10,000 car loan at a 6% annual interest rate. In the first year, you'll pay $600 in interest. Over the loan's lifetime, you could pay thousands more than you originally borrowed. The longer the loan term, the more banks profit. Now think about mortgages. These loans often last 15 to 30 years, meaning banks earn steady profits for decades. The credit card trap. Credit cards are even more lucrative for banks because of their high interest rates, often 20% or more. Here's a story to explain how it works. Meet Alex. He got a credit card with a $5,000 limit and a 20% interest rate. He used $4,000 for emergency expenses and tries to pay the minimum monthly payment of $80. But here's the catch. At a 20% interest rate, his balance grows faster than he can pay it off. Most of his payment goes toward the interest, not the original amount. Over time, Alex ends up paying far more than $4,000, while the bank earns a steady stream of profit from his monthly payments. Banks use compounding interest to maximize profits. This means they charge interest not just on the original amount you borrowed, but also on any unpaid interest from previous months. For example, If you owe $1,000 on a credit card and don't pay it off, the bank charges interest on that $1,000. The next month, you owe interest on the original amount plus the first month's interest. Over time, this compounding can turn a small debt into a massive burden for you and a massive profit for the bank. Banks design loans and credit cards to keep you paying as long as possible. High interest rates and minimum payment requirements make it easy to fall into a cycle of debt, where you're paying mostly interest and making little progress on the principal balance. To avoid falling into this trap, pay off your credit card balance in full each month to avoid interest. Shop around for loans with lower interest rates. Focus on paying off high-interest debt first, using methods like the avalanche method. Loans and credit cards may seem convenient, but they're some of the biggest ways banks profit off their customers. In the next section, we'll zoom out to see how these practices impact not just individuals but the entire economy. Stay tuned. Section 6. How banks influence the economy. Banks don't just shape individual finances, they shape entire economies. Their practices ripple out to impact markets, industries, and even governments. But this power often comes with serious consequences, contributing to economic inequality and instability. Banking practices can widen the wealth gap. Wealthier individuals get access to low-interest loans and exclusive investments, helping them grow their wealth. Meanwhile, low-income individuals face high-interest loans, overdraft fees, and credit card debt, making it harder for them to get ahead. This creates a system where the rich get richer, while those with less struggle to make ends meet. Banks' lending and investment practices also play a role in creating economic bubbles. Take the 2008 financial crisis, for example. Banks aggressively lent money to people for home purchases, even when they couldn't afford it. This flood of credit caused housing prices to skyrocket, creating a bubble. When the bubble burst, millions of people lost their jobs, homes, and savings, while the global economy suffered. And this isn't a one-time event. Banks' risky practices have contributed to major crises throughout history, like the Great Depression in 1929 and the dot-com bubble in 2000. When banks fail, the consequences ripple across the entire economy. To prevent complete collapse, governments often step in with taxpayer-funded bailouts. For example, during the 2008 crisis, the U.S. government spent $700 billion to save major banks. While this may have stabilized the economy, it raises tough questions. Why should taxpayers pay for banks' mistakes? Does this encourage banks to take even more risks, knowing they'll be bailed out? Banks' influence extends far beyond your personal finances. Their power to create money, fuel bubbles, and shape economic policy affects everyone. This concentration of power can lead to cycles of growth and collapse, where ordinary people often bear the brunt of the fallout. Banks have mastered the art of turning your money into massive profits. They use your deposits to fund loans, invest in financial markets, and charge hidden fees for almost everything. Through fractional reserve banking, they create money out of thin air, while high-interest loans and credit cards ensure a steady stream of revenue. Meanwhile, the average person earns next to nothing on their savings, and hidden charges quietly drain their accounts. It's a system designed to benefit the banks, often at your expense. But now, you know the secrets behind how banks operate. You don't have to let this system control your financial future. By understanding your strategies, switching to better options, and taking charge of your finances, you can make your money work for you, not for the banks. It's time to rethink how you use banks and take back control. Start today by exploring alternatives, paying off high-interest debt, and being mindful of where your money goes. Let's turn the tables. Don't just save money, make it grow on your terms. If this video opened your eyes to how banks profit from your money, don't forget to hit the like button and share it with your friends. They deserve to know this too. We'd love to hear from you. Tell us in the comments how banks have impacted your financial journey. Have you ever been hit with hidden fees or struggled with high-interest loans? Let's start a conversation. Make sure to subscribe for more insights into how money works and how you can take control of your finances. This is just the beginning. We've got plenty of valuable content coming your way, so stay tuned for our upcoming videos. Thank you for watching, and I'll see you in the next one.